Today we're going to touch on a number of things. First of all, as you know, I like to split the show in different sections. The first section is always an educational section. Today is December the 7th and 16th, and the educational section is going to be entitled How to Reach Trading Objectives in Money Management. This is a very, very important topic, and there is a lot of misunderstanding, if not plain ignorance, about risk management and money management, and what is the role of each. Some people believe that trading objectives, which could be a performance objective, like so to say 50% in 1 year, it's to be obtained through proper risk management. The reality is that it should be obtained with proper money management, and there is a difference between the two. I will show charts, and as usual, I want to remind you that I'm merely providing this material for your general information, and always do your own analysis. I will not talk about myself. I will just say that recently we have successfully launched the Winning with Algos community, and I'm offering a free package that includes a trading course of a little bit more than 6 hours. Also offering an ebook, and I will be offering 1 month of free trading signal service as well. So stay plugged in, because I'll provide more information as we go. This is my contact information. You can always reach me out at FibStalker@gmail.com. Today I'm going to talk about money management. There is particularly one research paper I wrote back in 2010 and then adapted in 2012, and it was published on the Journal of the Italian Society of Technical Analysts, and recently on the Journal of the Canadian Society of Technical Analysts. So, how we reach trading objectives with money management. This is very, very important, and I want to touch on this. If you like this content, you can always tweet the link on your Twitter account. So, before I get there, I mentioned the free trading course, and you can actually get access to the free trading course at winningwithalgos.com/start, and it's free. You can register, and let me know what you think about the content. Okay, so before we talk about money management, let's briefly touch on risk management. What's risk management? It's a way to protect our precious capital, and this is rule number 1 of trading, PPC, protect precious capital. It's also a way for the market to tell us that we are wrong, and we have to get the hell out of the market. Particularly, I'm very strict on this. And it's also a way that we can get to help sticking around until we learn the trading game, and this is very important as well, because as the money is gone, the game is over. So how do we practice it? There are different ways. There are ways to manage risk, of course, directly on the trade. There are ways we can set up a process that helps us manage risk. There are different aspects, but the very first aspect is to accept risk. And it is always very important when we deal with trading, which is just a different flavor of business, just a different business, to look at all the risk and to look at the downside. Or if you are working in London, look left for the car coming in a direction you usually do not expect if you live in the Western world. So Another way is to risk 1% or less. Sometimes people laugh and some people say, well, you know, I have risk capital, so my risk is going to be 5%, 10%, and I say good luck. And I also add that probably they do not understand what the market can actually be. The market is a beast, and most importantly, there's no need to take these risks in order to do very well in the market. And I'm going to show this to you today. And another way to manage risk is to trade only after price confirmation. If you have a way to confirm price, to confirm whether an area is getting participation, and if you don't have it, consider joining my FibStalker Methods coaching program, where I will guide you to develop a complete edge that includes also price confirmation, not using the common methods, breakout methods, and so on, but you're going to look at how algorithms are actually placed on the counter trend move in the smaller time frame, and when they give way or not give way to the developments of price on the larger time frame. And another way would be to adopting a free risk trade approach. I spoke about free risk in the past weeks, so you can go back and you can go on FX Trade, look for Giuseppe Basile, my name, and you will find also a couple of videos in which I spoke about free risk trade approach. And that's basically, if you watch the educational section the last 3 weeks, you will find a lot of information on that. Now, in order to speak about risk and money management, we also have to keep in mind some basic trading statistics. Most of you know this. A lot of people completely ignore this information. Of course, everybody speaks about reliability, right? We want to be right. It's our ego. We're all matchers. We want to be right as much as possible. Possibly 100%. This is impossible, so just forget it. No method will give this to you, and you need to live with losses. You will need to live with them. Expectancy is a simple, very simple formula that expresses basically how many dollars I can make for every dollar risked. For example, if expectancy is 1, which would be a good value for the expectancy, can be of course higher and can be much lower as well. That means that for every dollar I risk, I make $1. Now, if let's say that you have $10,000 and your risk is 1%, okay? That would mean that you risk on each trade, you risk $100. Well, every time you reach $100, the expectancy is telling you if the expectancy is 1, it means that you make $100. Now, this formula of expectancy is created in a way that it expresses what you earn in average, also on the trades where you risk 100% and you lost 100%. Okay, so the expectancy formula takes into account both losing and winning trades, and that's very, very important. Of course, the number of opportunities you have in a period of time, for example, a month or a week, are the number of proper setups that actually excuse me, satisfy your trading system or your set of trading systems that you use. It's very important. The higher, the better. Imagine if you have a good reliability, you have an expectancy with 1, or positive expectancy anyway. You want to maximize the number of opportunities. And the full picture is given by the expectunity, which is very simple. It's just the expectancy times the number of opportunities. And this gives you the dollar earned per every dollar risk in the period, not for one trade like the expectancy, but in the period, because it takes into account, very simply, all the opportunities, the number of opportunities that you generate in that period. All right, so very simple concept there. Nothing really complex here. So a system that wins a lot, which has a high reliability, might not be that good if the expectancy is not positive. There can be high reliable system that wins 80% of the time, but when they win 1, and then when they lose 5, for example. And in that case, the expectancy could be non-positive or small, in which case we are not interested. And if that's the case, when the expectancy is small, we need to generate more opportunity. So before I say that people laugh at risking 1%, when I tell them to risk 1% of the capital, some of them accept the concept, they understand the implication, because they understand what comes after that with money management. But some of them, they just look at me and say, seriously, and when all that leverage we have in Forex, and when I'm going to get into my first million if we only risk 1%? Well, they really do not understand the reality of the markets. And to me, the lovers are out of ignorance, because this is the loser concept that we need to trade a lot in the smaller time frames, or generate as many opportunities as possible, trade the news, trade often. But see, if you think about it, that's not what is necessarily needed for to be successful in trading. That's maybe what the industry wants you to do. Right? You have to trade a lot, you have to trade the news, you have to be involved at all times. Well, I have a different view. And this way of thinking is also the product not only of the industry, the marketing, but it's also the product of a modern society that wants it all and now, and does not value the importance of the gratification of delaying. Now, of course, you can always add more risk. So a lot of people come to me and say, well, this is my risk capital. I'm not going to risk 1%, I'm going to risk 5%. Fine, provided you know what you're doing. Some people risk 10%. Well, be careful now, because one big event can really start wiping you out. Think of the U.S. Swiss franc, what happened the beginning of 2015. So, and some people don't even know how much they are risking. In fact, they actually generate ideas which are discretionary ideas, and obviously more risk always produces higher returns when you still have your capital, because with those potential returns, it more often generates a higher number of basket accounts, 95%. Of accounts in Forex trade. And that's something that you don't want to do. 95% of starting traders lose 2,000s to 6,000s in a period of 3 to 6 months. And that's the reality. That's the current statistic. So the question is, do you want to be in the statistics, or do you want to try to do things differently? And that's the question. So what people ignore is that there are many things that needs to be mastered when it comes to trading. And as Alexander Elder said, any clown can buy and sell a financial security, but the reality is that you cannot trade, you cannot treat trading differently from what it actually is. And trading is a business. It needs to be treated like a business, and if you do business, you need to know the rules of business, which are different from the rules of being employed. And one of them is that you don't take unneeded risks. When you have your own business, you understand that you want to manage risk. You're not dealing with other people's money. You are dealing with your own time and money, and you want to be able to manage risk properly. Okay. Now, some people tell me, I'll risk 5% per trade because my capital is risk capital. I have to keep it sitting on the account. If I have to keep it there, I would rather buy a car with it. And now the point is, what must ignore is that it's really the basic of trading. They only look at the mechanics of trading, the method, the entry, the plan. The reality is that you can reach objectives in trading in different ways, and trading has many aspects that you have to master. If you can produce steady monthly gains, you can generate a fortune, and that's the key here. And the way you do that is through techniques of money management. That's how you do that. Okay. And so enter money management here. You reach trading objectives with money management, VANTARP. It's not risk management. It's not the method. It's not psychology, although psychology is very, very important in trading and it's required. But whenever you state some objectives, it should be performance objectives or risk containment objectives and so on. Excuse me. The tool you use to reach those objectives is money management. So if you risk 1%, your risk is your 1 unit of risk here is 1% of your account, and you can make 5 units of risk per month, you can generate large profits in a reasonably small amount of time. And you might ask now, and how do I do that, right? And I'm going to show you some of the techniques here. But before I get into those, I want to continue here and talk about the concept first. Okay, so how do you do that? And we'll get into the numbers in a moment here. Do that by leveraging the power of other people's money, particularly a technique that I learned from VANTARP is called markets money layers. Very, very simple. It's not as risky as other techniques, Kelly criterion and optimal F, and you name this. The concept is very, very simple. As you accumulate gains, so obviously you have to have a system which has a positive expectancy and that is capable of generating gains on a continuous basis. Of course, it's always in terms of average. It's never in terms of, today or this month I'm going to generate X from the market. And one of the reasons people fail in trading is because they bring their employee mindset to trading, which is a business. So if you have a way to accumulate gains, then what you do something very simple. You take larger risk on other people's money, which is the gains, the money extracted from the market. And as simple as this concept can be, a lot of people do not apply it. And when you do this, you can keep risking 1% on your own money and risk more, 2, 3, or 5% on market money. And I'm going to show you what that means. We're going to do some projection and show what that means for your account. So the beauty of this is that in case of very adverse events, like you risk 10 times your initial risk, right? You may lose a sensible portion of your gains, but only a limited portion of your initial capital, which keeps you in trading. Now, this is a very, very adverse event, but these events happen, and that's something that people who are who think that they can risk large amounts and use leverage, they clearly do not understand or do not believe that these kind of events they can happen to them. And so every time you hear someone risking a large portion of their account or using money management aggressively and using leverage, you should always remind yourself and them that these kind of events can happen, and they happen more often than what people believe in modern markets. So let's look at an example here. If you have an initial 10,000 capital and variable risk, we go back here and let's say that you have you have this amount here. You start the first month with 10,000, and let's say that Your risk is 1%. So this is going to be our risk here. I'm going to highlight it, 1%. Going to highlight it in orange, which means that every time we put up a position, the pip distance between our entry and exit has a value which is 1% of our account. In our case, 1% risk would be $100 here. So if every month we gain 5% in average, which means that some months could be 7, some months could be 10, some months could be 3, some months could be even negative or 0, then in average we will get something which revolves around these numbers here. It should be a little bit higher, but it revolves around this here. So the first month we have $500 in gain, 10,500, and the next month we actually risk 1% of that amount. So we risk a little bit higher, 105, and so on. As you can see, after 12 months with this strategy, we have a 71% gain. Okay, which is respectable, considering that we compound risk along with our capital. And again, this is in average, so there'll be some months in which this will be 2 or 3, and other months will be 10, other months might be negative, and so on. That's part of trading, of doing trading. Now, if we risk more, and I can show this here, if we risk 2%, obviously the risk is higher. The risk compounds more quickly as well, and also the gains compound more quickly, and you end up with a 185% return here. You go from 10,000 to 31, so it's even higher. It's 201, right? That would be your don't have it here, but you basically go from 10,000 to 31, 384,000 here. Now, again, we are keeping constants here. We're saying you generate 5 times the risk in average. And obviously, again, as I mentioned, these are the actual values would be around this, plus or minus, because that's the way it works. If one month you do 10% and then the next month you do 3%, obviously those will more or less even out. More or less, it might be less than this, maybe a little bit higher than this, but that's what you get. So the higher you risk, and you don't want to get necessarily there, but obviously the higher you risk, the higher is the return. The question is, can we actually generate higher returns with using a different techniques instead of risking 3% on my account? Can I do something different? Well, yes, you can use layers, and you can use what is called the money market layers here. And in here, I want to show first an example in which, the example in which we basically risk. So the way first of all, the way money layers works is that you have 2 different layers, and actually you can have as many layers as you require or you prefer, actually. Okay. Now the first layer here, it's our capital, so it's $10,000. Any gains over and above 10,000 gets into the second layer, which is a money market money layer. For example, when our account is at 10,500, our market money is $500. Okay, and so on. Now, as we gain more and more, we can actually risk more on our second layer here, the markets money layer. So instead of risking, for example, 1%, as we did in this example here, and again, I'll go back to 1% here, we generate 71.03%. What we do is we risk, let's say, 1% on our own capital, and we risk much more, for example, 3% or even more, 4%, 5% on what? On the money market, on the market's money. Okay, so for example, if it is 3% on the market money here, right? 1% of market money would be $5. In this case, 3% would be $15. And so we add the $100 that we risk on our own capital to the $15 that we risk on markets money here. And as you can see at the very beginning, our risk increases to 150, 115. In the previous example, we had 105. But it is not just a different way of risking here. Simply conceptually, we are risking more on other people's money and less on our money. Okay, and when we do that, we obviously obtain totally different results. In fact, way more here. We go from 10,000 to 24. 501, and before it was only 17. So as you can see, a simple improvement here. Now, if we raise 5% on market money, can you see that the results start growing exponentially here? And as you grow, you could actually have a layer for the first 10,000, then a second layer for the next 10,000, and then a third layer for the following 10,000s, and using a different risk. As your capital grows, you can reorganize your layers in a way that you risk only what is necessary. So you can clearly see here that this technique allows you to compound on by risking more on markets money, and obviously it's a way of seeing and protecting your capital as well. If your market money goes because you're risking more on it and there is an adverse event, remember you still have your capital that you can use for trading. Of course, you don't want to make this risk too big. You don't want to make 10, 20% of risk on your market money. Or if you become so extreme, you want to do only for a smaller amount of money. And that's the key concept here that I wanted to give you today. And these are not just numbers, because when you have a method that can actually give you an average 5 times your risk per month, and clearly it's a method with a positive expectancy, generate opportunities that actually allow you to get these results, then using the layers, it becomes possible. And obviously, if you have edges that allow you to generate the double of that, and you can generate a lot of opportunities intraday, you can see that this number starts growing very, very quickly, even if you just is 3% on your account. So clearly, the expectancy and the number of opportunities, or the expectunity, are key to this approach, and will determine how quickly you can be successful. But even return like 5 units of risk that we do in the FibStalker Trading Signals room are actually good enough to actually leverage your results. Okay, so this is the idea here, and if you need a trading methods guiding the way market money works, here are some of the expectancy and expectancy that we get when we get the full risk. The basic swing gives us 60% winners, 40% of losers, and they're distributed more or less like this. So we have between 5 to 8 opportunities every month. and typically a winner is 2.5 the loser. So this gives us an opportunity of 7.15, which in average it's very close to that 5 unit of risk that we need. If you apply a risk-free approach, and if you want to learn more about risk-free, you can watch some of the presentation in the last few weeks. And there it's slightly different, because when we have the risk-free approach, there are a number of losers that we close to break even as well. So this allows us to reduce the times we get stopped out with a loss, which is only to 20%, but obviously the expectancy goes lower. The advantage of this is that it's easier to stay in the trade, because with a risk, when we manage risk, clearly and we get a risk-free, so we get half of the position out at the risk-free level. There is less pressure on the trade and on the trader as well, and so it's easier to stay with the trade, and we generate less stops with a loss. Of course, we pay that in terms of expectancy and opportunity, but 5.50 is still very close to that 5 unit of risk that we want. Obviously, the great advantage is when we fully use the FibStalker methods with the FibStalking timing technique, which allows us to generate a lot of risk-free trades, and we can have between 20 to 40 opportunities by timing on the 1 hour or 15 minutes, with an average of 30 opportunities. And there, again, there is a different distribution of losers, break-even, and losers, break-even, and winners. Which actually the winners have much higher average return to risk, around 40 in average, and the expectancy goes higher, but most importantly, the security goes higher, and we can get a lot of opportunities there, which balance the higher number of losses.